Linked covers essentially mean that two different types of cover are linked together in that if you claim on one of them, then that reduces the balance that you have on the other cover.
Fast forward several years, client had a motor vehicle accident, was a nurse. We made a claim for TPD. The insurance company, as you mentioned in their process, they looked at it and said, can you do any occupation?
Because the premiums are being paid for through your super account, it doesn't impact your day-to-day cash flow. There will be some tax advantages to getting your premiums paid through your super.
Legal super or rest, they don't pass the benefit balance in, but I won't go too deep into my frustration with regards to that. But the policies we set up, our clients get that 15% deduction on those policies.
That's right. Yeah.
But at the end of the day, insurance is at its core relatively simple. How much cover do I want?
Yeah.
How much am I willing to pay? Let the experts, geek out about their tax position and after tax position. Hey there, welcome to another deep dive topic. And today I got Neha with me. Thanks for joining me, Neha.
Thanks, Phil.
So today we are going to be talking about structuring life insurance policies between superannuation or outside of super. To get us started, what type of policies are we talking about and what are the different options in terms of the ownership?
Yeah, so there are four main types of policies that we're looking at. So there's life, which is also called death cover. And this pays out a lump sum to your beneficiaries if you pass away. And we have total and permanent disability or TPD. This pays you a lump sum if you aren't able to work ever again due to some illness or injury. Then we have income protection policies, and this pays you a monthly benefit if you're unable to work due to injury or illness, and it could be on a permanent basis or temporary. And finally, we have trauma insurance, which pays out a lump sum to you if you're diagnosed with a critical illness. So it could be something like cancer or stroke.
And I actually like calling it 4.5 policies because there's also child's cover as well. But it's kind of sometimes it's attached to policies, sometimes it's on its own. So cool. And then what are the different ways we can own these policies?
Yeah, so most commonly life and TPD policies are owned inside super. However, you can own them outside as well. Same goes for income protection. Trauma insurance is the only cover that you can't hold inside super. That has to be outside. And there are reasons for that I'll touch on in just a second. When we talk about holding a policy inside super or outside super, what does that mean?
I was just about to ask that question.
Yeah. Essentially, it just means if you have a policy inside super, the premiums on that policy are being paid for using the money that's in your super account, so your super balance. So whatever contributions your employer is making to your super account, a portion of that is used to pay the premiums on your policies. And if you're holding these policies outside of super, it just means that the premiums are coming out of your pocket through your personal cash flow.
Yes, and so we talked about your employer's contribution paying for that. So the other thing is if you are off work, unpaid work or your parental leave, your balance of your super can still fund it. So you don't need employer contributions to be going in to fund it as well. So now we're going to talk about a little bit of jargon here, but that's what the purpose of the deep dives are, is to talk in depth. So there are things called like linked policies, and also the other technical term, some insurers call it super linked. So talk to me about what are those two things? What do they mean?
So linked covers essentially mean that two different types of cover are linked together in that if you claim on one of them, then that reduces the balance that you have on the other cover. So just as an example, you have a life cover of $1 million and you have a total and permanent disability cover of $1 million, and the two of them are linked. So what happens is if you get permanently disabled for some reason and you claim on that TPD cover and you claim $500,000 on that, then that reduces what you have available on your life cover later on. So later on, if you pass away, your beneficiaries get only $500,000 from that life cover as opposed to the original $1 million.
And the other way of owning it is if you had two separate policies, you're going to get charged more because it's a much bigger pool of money, but you claim on one, doesn't impact the other.
Yes.
And talk to me about super linked. What does that actually mean?
So super linking these policies just means that whatever definitions or benefits or features that aren't available inside super, you can still hold your policies inside super essentially, but pay a little extra on top of that and get access to those benefits or features. So just as an example, it would be on TPD, we have the any occupation definition and own occupation definitions. So any means that if you're permanently disabled and you're never able to work in any occupation ever again, you're eligible for a claim. And this is only available inside super, or rather, if your policy is inside super, this is the only definition that you can have on your policy. So it's a bit strict there. But if you want an upgrade to that definition and make it an own occupation definition, which allows you to claim on the policy if you're unable to work in your own occupation at the time of your disability, then that isn't usually available inside super, but you can pay a little extra on top by super linking those two covers and get that definition available to you outside.
And let me take you on a history lesson. But I remember when I first started in the industry, people used to talk about these old policies, or I remember when this first came in. Well, I actually remember when these super linkings first came in. It was around 2014, 2015. And I'm aging myself because that's more than 10 years ago now. The reason these came in is because the government used to allow really any policy to be owned through super and paid from super. The issue was the money was paid through super and then claimed on. It went into super and then you couldn't access those benefits. So you were kind of locked out of gaining them. So the government came in and said, look, you can only fund policies through your super fund with policies that can be paid out on claim. And so it limited these own occupation TBD or some really beneficial income protection policies. And so the industry said, well, we still want to allow super to fund it, but we still want these extra benefits. So that's when they apportioned those costs and said, okay, for own OC TBD, super linked, 2/3 will pay inside of super and then 1/3 you fund individually. So there's a bit of a history lesson and dating myself at the same time. So you touched on any and own OC TBD. So let's dive into that a little bit more. And we've actually had a client make a claim on that. But maybe spend a little bit more time explaining exactly how they work structurally.
Like I mentioned, inside super, you can only get that any occupation definition. So what would happen in our clients' cases would be that they own a large portion of that policy inside super. So a majority of their premiums will come out from their super balance. In certain cases, if you are eligible for that own occupation definition, so the premiums inside super would be paid annually through a super rollover or whatever it is they've set up there on that side. The own occupation definition can be paid for as an upgrade, and this would just come out of their personal cash flow on a monthly basis.
Yeah.
And on the policy document, you would just see the two as super linked. And what happens is at claim time, the insurer would first look at what the policyholder has inside of super. First check, are they eligible for an any occupation claim or not? And it is quite a restrictive definition. So if they are eligible for that, well and good. If they are not, then they will check to see if this person has the ONOC feature or benefit available to them. And if they do have it, then they would get paid out.
So there are two different types of super ownership. So when we talk about like the super funds, like Australian Super, who allows for your insurance to be increased or the default, can we access those features you talk about, like own occupation TBD through Australian Super?
No, so group insurance policies will not have that feature available. It would have to come through a retail policy that's usually set up by an advisor.
Yeah. And to give you an example also, so we had a client who just recently claimed a few weeks ago talking about that own occupation claim example. So we had a client actually was with Australian Super when we saw them, had $56,000 worth of any occupation TBD. We went through the process, made a recommendation to take out $1.5 million worth of TBD because the client's quite young. Your income earning years is significant when you're quite young. And so the client took out the cover and we had that own occupation benefit on the policy. Fast forward several years, client had a motor vehicle accident, not in a good way, was a nurse. And so we made a claim for TPD. The insurance company, as you mentioned in their process, they looked at it and said, can you do any occupation? Well, the answer is yes, you probably could have. But they made an assessment, can you do your own occupation ever again? And they determined that the client couldn't go back to their own occupation. So they got paid out that own occupation TBD policy. And And back to that Australian super example, they wouldn't have been paid out a claim because it was only limited to any occupation. So we'll touch on, actually we'll go through that client example a few times because we're going to touch on tax and how it all works when we're paying premiums. But just like TPD, income protection sometimes has a super linking option as well. So talk to me about that.
Yeah, so things have changed along the years with all of these policies, but there are some insurers that are still super linking the income protection covers. So on your policy document, it may look like you have two different policies, but just like we were talking about the TPD definitions and how some upgrades are available outside of super, it works similarly with income protection as well. So a majority of your premiums would come out from inside your super, but there are some definitions like own occupation, which would be sort of a second policy attached or super linked, and that would be paid as an additional through your monthly cash flow.
Yeah. And one thing that's really important for anyone watching, when it comes to income protection, there are some really distinct policy differences. So with, as we talked about, TPD, if you own an own-oc split TPD policy between super and pay for some of it through cash flow, it's exactly the same policy as if you own the own occupation TPD 100% outside of super. But those two are very different to any occupation inside of super. Income protection is a little bit more kind of nuanced, whereby some policies that are owned through super have a requirement when it comes to income protection that you need to be gainfully employed at the time that you have a date of disability. So it's really important if you, like Australian Super is a great example. They're the biggest super fund, so I'll keep mentioning them. But they have a rule whereby you need to be gainfully employed at the time. So if you go on a holiday and you quit your job, you go on a 6-month holiday and then you injure yourself overseas, even if you've got an income protection policy, you're not gainfully employed at that point in time. Sometimes like parental leave depends on the contracts and the workplace arrangement. If you've got a job to come back to, then you may still be considered gainfully employed. But if you don't, if you quit your job, you go on parental leave, and your plan is to try and find work elsewhere, then you're not gainfully employed. And so the reason I mention that is because they're very different claims outcomes. When we talk about super linked policies for income protection, that kind of gets around this idea that you need to be gainfully employed at the time that you're injured because you're paying for that feature outside of super. Now, one thing that's a fairly recent innovation in the market is that some income protection policies allow you to pay 100% of the premiums inside of super, but still be able to get claimed, still be able to claim on those policies if you are not gainfully employed at the time of claim. If and only if a financial advisor set up the policy. Now, why that's the case, it doesn't have to be a financial advisor, but that's predominantly where those policies are set up. And the innovation is, I mean, my personal view is it's good for our clients, but I think it's a little sketchy. But the innovation is the insurance companies say it's a complementary feature of the policy. But like Australian Super don't offer that complementary feature. And so it's a little bit tricky, this ownership of income protection. You may not have the exact same policy if you own 100% of it inside of super versus 100% outside of super. So again, if anyone does have an income protection and they're not sure if those rules apply to them, reach out to your financial advisor. But if it is owned through the group policy, through super, it won't be eligible for that feature. Okay, so let's talk about the pros and cons of each ownership style, and then we'll talk about tax. How does tax impact all of these?
Before we get to the tax part, I think essentially the main advantage of having some of these covers being held inside super is just that they're cash flow friendly. So because the premiums are being paid for through your super account, it doesn't impact your day-to-day cash flow as much, and there will be some tax advantages to getting your premiums paid through your super. So like with life and TPD covers, the super fund that you're paying the premiums from can claim a deduction of up to 15%. So that essentially brings down the cost of your insurances to you.
Assuming the super fund passes that benefit back to you.
That's right,
Which some super funds like Legal Super or Rest, they don't pass the benefit back to you, but I won't go too deep into my frustration with regards to that. But the policies we set up, our clients get that 15% deduction on those policies.
That's right.
Yeah.
So that's the main advantage there. The only thing that you need to consider is with income protection can be held inside or outside super. But if you hold it outside super, you can get a bigger tax deduction. If you're in a higher marginal tax rate or tax bracket, then you can claim personal tax deductions for that income protection premium that you're paying.
Okay, slow down. I'm not that clever, so I need a bit of time to work this out. So, if I'm paying $1,000 and that $1,000 premium is paid from super, how much of a tax deduction will the super fund receive?
It would be 15% of a tax deduction.
Okay, so my net premiums after tax is $850 for that $1,000 per policy.
Yeah.
So if I am paying that outside of super and my marginal tax rate, so the tax bracket that I'm in is 34%. Wait, is that a bracket these days? These brackets, they keep on moving all the time. It's 34 including Medicare levy. Yeah. So if it's 34, that $1,000 policy, how much am I going to get back in my tax return?
It's $660.
$660. Yeah. So again, those, depending on the tax rate, but if I'm in the tax-free threshold, so I'm earning, maybe I'm parental leave, so I'm not earning an income at the moment. So that $1,000 policy, I actually don't get a tax deduction because I'm not earning any income. And so the net after-tax premiums is $1,000. So it is variable when it comes to the after-tax costs of those policies. The other pro or con of the ownership style, before we go real deep into tax, because I do love talking about tax, is that, yes, your cash flow pays for it, but one thing to always note is that your super fund is for retirement savings. Now, there are benefits. We can fund insurance, but it will have an impact on your retirement savings on a long-term basis. So it's one thing that just from a personal point of view, there may be times where it makes sense to own it through super because, you may be tight on cash flow, especially think about people like, new professionals, you're generally in your lowest income earning years, or young families where your need for insurance is actually at its peak, but your cash flow, as someone who's kind of getting on the other end of a young family, my daughters aren't super young, cash flow is really tight for young families. So the ability to fund those policies for, the mum or the dad, for policies are really important. If something happened then, it's really devastating, is important to fund through super. But the downside has a big impact on super balances over time. So we talked about the different, after-tax difference being owning through super versus owning personally. It sounds like it's always better to own personally, but is there a way we can get that same tax benefit, whether it's through super or non-super?
Yeah, you can make additional contributions to your super fund. They're called personal contributions, which then pay for the premiums on that policy, and then you can get the same tax benefits there. Yeah,
you can do that either through making a tax deductible contribution or through salary sacrificing as well. So that $1,000 policy, if you want to break, if you get paid weekly or monthly or fortnightly, however you get, you can just work out what that $1,000 is and salary sacrifice for that as well.
In these cases, could you talk to us about what a notice of intent to claim is and when that applies?
I like how you handled that one to me. So great question. Thank you. So if you salary sacrifice, you don't need to do a notice of intent to claim because the workplace already pays you the after-tax amount, and so it gets managed by the workplace. If I'm making a personal contribution, so $1,000, I make a personal contribution into super. I've got to make a notice of intent to claim a tax deduction. So basically, what that does is the super fund says, okay, we're not claiming a tax, we're not going to charge you 15% tax on this contribution because you're claiming it on a personal, you're claiming it in your personal tax return. So that $1,000 contribution, instead of the super fund taking 15%, I get to go and claim $1,000 tax deduction on my tax return. But I've got to notify the super fund about that. And so that's what a notice of intent to claim is. Now, one thing to note is it's important if you put $1,000 in, do the notice of intent to claim straight away, because let's say I'm with Australian Super at the start of the year. I put $1,000 contribution in August, and then in October I decide, actually, I want to move my super funds from Australian Super to Host Plus. I go and make that change. If I haven't made a notice of intent to claim a tax deduction, then and then I go tell Host Plus, actually, I made $1,000 contribution. Can I claim it? They'll say no, you can't claim it because the money is moved across to another super fund. So I've got to make that notice of intent to claim just after I make the contribution, and then Australian Super will notify Host Plus to square it all off and pay the ATO the right amount of money. And the reason why this matters for our clients is because we structure the policies so it's so a small portion of their super fund gets rolled over to another super fund every 12 months. And so it's important that they make that notice of intent to claim straight away. The other way to just not have to deal with the life admin is just go to your workplace and say, hey, can I salary sacrifice this? Because you don't actually need to worry about any of that stuff. Let's talk a bit more about tax implications. So tax on premiums, we touched a little bit about that, but is there anything else that we need to touch on? Maybe trauma or child's cover. Is there any tax benefit in paying those premiums?
So with trauma covers, there are no tax deductions on the premiums for those. And the benefits as well, if you were to claim on a trauma policy, it's a tax-free lump sum payment to you. So no issues with tax on trauma policies.
Yeah. And generally speaking, and we'll touch a bit more about tax, is if you get a tax deduction for it, the ATO will then want the money if you're claiming on it. But if they don't allow you to get a deduction on the premiums, then they're unlikely to tax you on the policies. So touch on same as child's cover. Is that tax-free both ways?
Yeah, it is tax-free both ways.
Yeah. So when you receive the money, you're not paying tax on it, and the premiums you don't get a deduction.
You don't get a deduction. Yeah.
All right, now let's talk about the funky ones. So income protection. We did talk about the deductions to the super fund or personally, but what happens on claim?
So at claim time, if you are receiving a monthly benefit on your income protection policy, this is treated as a regular income, and it's going to be taxed at your marginal tax rate.
Yeah. And as you talked about, the marginal tax rate's the bracket, so whatever bracket you sit in. And you can go through like paycalculator.com is what we often like to look at just to work out what the post-tax benefit is. And it's really important for people to understand when they look at their income protection benefit amount, work out that's the pre-tax benefit. It's like saying your income is $80,000, but in your bank account, you're only getting paid, $60,000, whatever the number ends up being. It's the same when it comes to income protection. That monthly benefit is pre-tax benefits.
Yeah. And this is regardless of whether you own that policy in super or outside super. Those benefits will be taxed.
Yeah. All right, now let's talk about life insurance. How does that get taxed? Is there a deduction on premiums between super and non-super? And how is it taxed when we're making a claim?
So with life and TPD policies inside super, the super fund can claim a tax deduction on the premiums up to 15% if they are eligible for that. And the payout as well depends on what claim you're making and how long you've been in a service period with that super fund and what your age is at the time of claim. A portion of that payout could be taxed and a portion of it can be tax-free. So it's a little bit of a complicated calculation there with life and TPD claims.
Okay. Let's actually put the tax on claim aside for a second for super policies. Now, outside of super, for life and TPD, can you claim a tax deduction on those premiums?
No, outside super, you cannot claim any tax deduction, and the payouts are tax-free as well.
Yeah. Okay. And so now let's go into the tax on claims if it's owned through super. So it's complex. Let's just touch on life insurance. So life insurance, how does that work?
You'd have to work out whether your beneficiaries firstly are CIS dependents or tax dependents. So that again has some complexity involved there. So let's say an adult child, if you have an adult child, they are your CIS dependent according to the superannuation rules and regulations, but they are not a tax dependent. The tax calculations on that benefit payout would be a little complicated there. So a portion would be tax-free, a portion would be taxed. Just need to work that out.
And to get to this isn't a deep dive on what a CIS dependent is or what a tax dependent is, but just a rough overview. So CIS is the Superannuation Industry Supervision Act, and that means what money can come from super and go directly to someone. So if you pass away, your money can go directly to an individual, and it doesn't actually need to go through the estate. So it can actually sit outside the will. So what is and isn't a CIS dependent is really the question that we're answering is, can money go directly from super straight to me? Because if you're an adult and we're not a CIS dependent, the money actually needs to go to the estate first and get distributed to adult children through the estate and not directly from the super fund. Now, tax dependent is that measurement of what will pay tax and what won't pay tax. And so, again, it's like the age of the dependent. Are they financially dependent and reliant on the individual who's passed away or not? So there are some factors that come into that. So if it's a spouse, if it's non-adult children, anything like that, anyone who's financially dependent with that regards, it's tax-free money for life insurance. So they're the common ones. Anything outside of anything a little bit funky in terms of like family situations, that's when there may be tax payable on a life insurance benefit. But TBD is a payment, I'm still alive and I'm TBD'd. So how is that taxed?
Yeah, there are a number of factors to consider here. So firstly, when did you become a member of your super fund if your policy is owned inside super? So when did you become a member of that super fund? How long your service period was up to the date that you got disabled? And from your date of disablement till the age of, is it 65, I think, what that period looks like. So before your disability, the TPD payout is going to be apportioned based on these timelines. So looking at the portion before you got disabled, that portion would be taxed. But after you got disabled, it would be tax-free.
Which is confusing. So basically, the younger you are disabled, the less tax you'll pay is basically how it works because you haven't been working as long. The other thing to note is it's not just your super fund. So if I go and sign up to Australian Super and have it as a fresh super fund that no money goes into, then it's the date I joined that fund. But as soon as I roll money from another super fund, let's say I had one when I was 18. How old am I today? I'm 38, so that's 20 years ago. If that gets moved into Australian Super, then Australian Super will note that new date of joining the fund is actually 20 years ago. And so if I had a crystal ball and knew I was going to be totally and permanently disabled in a year's time, I would set up a new super fund and then not mix any other super money into that super fund and then claim on it because there's going to be very little tax. But no one's got a crystal ball. We don't know what's going on, so we can't manage our tax affairs. You wouldn't set up a new super fund and own a new policy every 12 months. It just doesn't make any sense whatsoever. But that's theoretically how it works. The longer you're in the super system, the more tax you'll pay on a disability. But there is an age in which it does become tax-free. Do you know what that age is?
That would be 60.
Yeah. So if you claim on the TBD policy after age 60, then there's no tax. And so we actually had a interview with an advisor recently, and we asked them the question about does the tax get triggered when you get paid a claim and get paid a claim into the super fund, or does it get triggered when you try and pull the money out of super?
The tax gets triggered when you're trying to withdraw the money, I believe. Yeah.
Correct. Yeah. So if you own the policy through super and you get paid a claim and the money stays in the super fund, then there's no tax. So if you're 58 and you're disabled, money gets paid in, and you obviously financially you can wait, then you'd wait until age 60 and it's fully tax-free because at 58 you're kind of at your highest taxable amount because you've been in the super system, much longer.
There's a question here with DPD policies. So if you are not eligible for any occupation claim, but you are for an own occupation claim, so how does it work with regard to that claim payout and tax?
Yeah, so I think as I talked about, when I went back in history, talking about back in my day when these policies first came in. So the reason they split the policies is because, as you said, they look at any occupation first because that's required and that's the most generous. Yeah, it's a good question. So as I talked about back in my day when they first came out, the reason they split the policies is because super funds can't pay for a premium that can't be paid out of super. So under the SIS Act definitions, if your own occupation TPD, so you can't do your own occupation, you actually can't receive that money out of super because you're not considered totally and permanently disabled under superannuation rules. So what actually happens is that the insurance company makes that assessment, and if you are considered own occupation, the money just goes straight to your bank account. It just doesn't, it bypasses super completely. And so given that it goes straight to your bank account, and own occupation premiums, those portion of the premiums are not tax deductible, it means if you get paid out a claim on own occupation TPD, there is no tax on that benefit. So as I talked about, we had this example of this client who wasn't considered any occupation, but was own occupation, and went from having an Australian super policy worth like $54,000 or $58,000, and now it ended up being $1.6 million. That was tax free. So $1.6 million of tax free because the client was eligible for an own occupation TPD. So that's why there's these funny things when it comes to paying your TPD premiums and you've got an own occupation portion. It's not tax, you can't claim a tax deduction. Well, sometimes that's really annoying because I want a tax deduction. But when it comes to claiming, just like a trauma policy, you're not paying tax on that. Okay, this has been really good. I think we've touched on a lot of things. The other thing that we haven't really touched on yet is what is our kind of default position that we think is really reasonable for our clients that we're seeing?
Yeah, in most cases, I would say we see our clients holding life and TPD covers inside super, mainly because of the flexibility that they would have with their cash flow outside of that. We don't want them to be too tight on cash flow. With income protection, it depends on the client's situation and what they're comfortable with. So if they are in a higher marginal tax bracket, then we would recommend that they hold it outside of super just for those tax benefits. But then again, depends on how comfortable they are in terms of their cash flow situation there. When it comes to linking the life and TPD, now most insurers would offer discounts if you link the two. Now the catch is that if you make a claim on one, that reduces the balance that you have on the other cover. So maybe you could talk to us about why we have defaulted to this, and is that a bad thing when we structure our policies this way?
Yeah, so in terms of, our philosophy is, guys, we want to, we ask our clients a million questions up front. There's a whole bunch of research. But in terms of our structures, we like to just have it fairly formulaic in terms of this is what we think is important. So for life insurance, the reason we own that through super and we're okay if someone has a non-tax dependent paying tax on that benefit is theoretically there isn't actually a need for that life insurance to be paid out. Life insurance is for dependents who is financially dependent on the individual, and if that is the case, then it's tax free. So that's why we own it through super, and the premiums you get a 15% discount versus post-tax premiums. TPD, we own a lot of that through super, but we link it with own occupation, as we talked about that super linking. And the reason we do that is, again, we believe that own occupation is really important, but also the tax, the most tax anyone's ever going to pay on that policy is 22%. And so getting a 15% tax deduction, and most of our clients are claiming are not going to pay anywhere near that 22%. And there's plenty of ways we can mitigate that 22% as well. We feel like that's the best overall position for our clients. With the exception of clients may be capping out their super contributions, and so we may want to think about not eroding their super balance, but generally that's not our clients. Income protection, is really just about marginal tax rate. What's the best after-tax position, and also from a cash flow position, what do our clients want? And then trauma, we don't get a choice. But in terms of linking the policies together, income protections is standalone, so that whatever you claim on that doesn't impact anything else. But the lump sum, trauma, TPD, and life insurance, we link it together because the the premium saving is significant on those policies. And the other thing is, for our clients, our average age is 36. Like, the requirement for life insurance is important, but the disability is really the biggest cost for individuals if they were to be disabled. And so, we see it all the time that in our levels that we think is important, life insurance is often much lower than disability insurance. And that's our philosophy is we want to replace your income until retirement age between income protection and disability. And so theoretically, if we can replace your income, then you're going to, retire with your full income being paid out across those two. So that's why we link it, because we feel like if someone is totally and permanently disabled, they're going to receive much more than their life insurance benefit that we think is important. So we link them together, because if you're disabled, it is much, much, much more expensive to still be alive than to pass away. Obviously, from a human point of view, we want people to still be alive, even if they are TBD'd. But that's why we link them together, because we believe that the overall net savings on premium is worth that, linking those two together. All right. Well, I think this has been a really good deep dive. I think it's super helpful for people to understand, what are the different options out there? When we talk about ownership, what does that actually mean? And why we've chosen the things that we've chosen for our clients. Before we finish up, is there anything else that we haven't really touched on that you think's important to touch on? Or is there anything, like any major point you want people to take away from this?
Well, I think we've touched on a lot of things here today. There's nothing much that I can add. We've looked at the tax implications, both on the premium side of things and on the benefit side of things. Ownership inside, outside super. I think we've answered most of the common questions that we get from clients as well.
Yeah. And I guess my takeaway is always like we do a lot of work in thinking about the tax. So, making sure we're considering tax on TBD levels of cover, all of those things. But at the end of the day, insurance is at its core relatively simple. How much cover do I want?
Yeah.
How much am I willing to pay? Are there any terms and like exclusions or loadings on the policy? Let the experts, geek out about their tax position and after tax position. And we run that through clients, but at the end of the day, we don't expect any clients to walk away from the meeting knowing how TBD tax, is calculated. Yeah. But we'll do that work and determine what levels of cover we think is important.
Yeah.
Amazing. Thank you so much, Neha. If you enjoyed this episode, there will be some other videos on the screen that you can check out. And thank you so much for watching.